Most people are destined to lose capital during the next market downturn. And the most alarming part is that they won't even understand the root cause of their own panic. They will sell at the wrong time and exit with less than they started with. However, a select group of investors, those who grasp the principles I am about to share, will emerge from the chaos with greater wealth than they had before the volatility began. Today, I will demonstrate exactly how to structure your compounding strategy so that a market crash doesn't destroy you, it actually makes you wealthier. Let's address something that most financial content completely ignores. While everyone talks about long-term investing and staying the course, nobody breaks down the actionable steps you need to take right now. My goal is to ensure that when the market drops by 30, 40, or even 50%, you aren't the one panic selling at the worst possible moment. Instead, you will be the one buying. I have studied market history extensively. I am not here to fearmonger, but you deserve the unvarnished truth. Market crashes are not rare anomalies. They are a standard, recurring feature of investing. If you don't know how to navigate them, you will inevitably lose money that could have been preserved. Here is our roadmap. First, we will explore how compounding actually behaves during a crash, as it operates quite differently than most assume. Next, I will guide you through 3 specific actions you can take today to prepare. Finally, I will present the data that proves why those who prepare for volatility consistently outperform those who do not. This is critical knowledge, so please leave a like and let's dive in. Part 1. The hidden fragility of compounding. Albert Einstein supposedly called compounding the 8th wonder of the world. It is the process where your money earns returns, and those returns, in turn, earn their own returns. It is one of the most powerful forces in personal finance, yet it possesses a fragility that most people ignore. The issue is that most investors don't understand how compounding interacts with market crashes, leading them to take the wrong actions at the exact wrong times. Consider the math. If you invest $10,000 and earn 10% in year 1, you have $11,000. Another 10% in year 2 brings you to $12,100. This is compounding in motion. Now, imagine a 40% market drop in year 3. You aren't at $13,310 anymore. You're down to $7,260. You haven't just lost your gains from the first 2 years, you've lost a portion of your principal. To get back to $12,100 from $7,260, you don't need a 40% gain, you need a 67% gain. This is the asymmetry of losses, and it is perhaps the most critical mathematical concept in finance. This is precisely why those who panic sell during a downturn often fail to recover. They lock in losses at the bottom and miss the inevitable rebound. According to a Fidelity study, if you had invested $10,000 in an S&P 500 index fund from 1980 through 2022, you would have grown that to over $1 million. But if you missed just the 5 best trading days across those 42 years, your total would drop to roughly $670,000. Miss the best 50 days, and that number plummets to just over $76,000. You endured the same risks and the same crashes, but you ended up with significantly less wealth simply by being out of the market at the wrong moment. Compounding is powerful, but if you interrupt it, you don't just slow it down, you can set your progress back by years. The goal is to never stop. If you want to ensure you always have the capital to keep your momentum going, you can look into starting a YouTube channel with my guidance via the community link below. It remains the golden opportunity of this decade. Part 2. How often do crashes happen? One of the biggest mistakes investors make is viewing a market crash as a once-in-a-lifetime catastrophe.
You need to understand three distinct levels of decline. First, a market correction, which is a drop of at least 10%. These have occurred on average every 1.2 years since 1980. If you've been investing for 5 years without seeing a correction, you are statistically overdue. They are healthy, routine resets. Second, a bear market, which is a drop of more than 20%. Since 1932, these have appeared roughly every 4 to 5 years and typically last about 10 months. While they feel harsh, remember that bull markets historically last more than 3 times as long. Third, a full market collapse, a drop of 30% or more. Think of 2008 or early 2020. These are rare, but they are inevitable. The question isn't whether a crash will happen, it is whether you will be prepared when it does. Part 3. 3 essential actions to protect your compounding. These steps must be taken now, before the market turns, because by then it will be too late. Step 1. Protect your foundation. You must maintain an emergency fund, 3 to 6 months of living expenses in a high-yield savings account. During a crash, people often encounter personal financial shocks like job loss or unexpected costs.
Without an emergency fund, you will be forced to sell your investments at the bottom to cover those expenses. Your emergency fund is not an investment. It is insurance that prevents you from having to sell your actual investments at the wrong time. Step 2. Implement automated dollar-cost averaging. Instead of trying to time the market with a lump sum, you invest a fixed amount at regular intervals. When the market is up, your money buys fewer shares. When the market is down, your money buys more shares. Over time, this reduces your average cost per share and forces you to accumulate more assets precisely when they are on sale. Automating this is key as it removes emotion from the process. When the news labels a market drop a catastrophe, your brain will scream at you to stop. Automating your investing ensures you keep buying regardless of your emotional state. Step 3. Ensure proper diversification. Diversification does not mean owning 10 different tech stocks. It means spreading capital across different asset classes, sectors, and geographies. A well-diversified portfolio might include a broad U.S. stock market index, international exposure, bonds for stability, and perhaps a small allocation to real estate. When one part of your portfolio crashes, you can rebalance by selling a bit of what has performed well to buy more of what has dropped. This is the professional buy low, sell high strategy. Concentration is what ruins long-term compounding. During the 2008 financial crisis or the dot-com bubble, those heavily concentrated in one sector lost decades of progress. Part 4. The psychology of the investor. The ultimate determinant of success isn't just strategy, it is psychology. During a crash, your brain will trigger loss aversion. Psychologist Daniel Kahneman found that the pain of losing money is roughly twice as intense as the pleasure of gaining the same amount. This is biological, not a character flaw. The solution is to create a written investment plan while you are calm. Document what you own, why you own it, your risk tolerance, and exactly how you will react if the market drops by 20% or 40%. When the market crashes and emotions run high, consult this document. It serves as a tether to your rational self. Peter Lynch's Magellan Fund averaged nearly 30% annual returns, yet many of his investors lost money because they bought when the market was hot and sold in a panic. Don't be that investor. Part 5. What the data tells us. Finally, look at the numbers. J.P. Morgan research shows that many of the best trading days in history occurred during or immediately after major crashes. 7 of the 10 best single-day returns during the 2008 crisis happened within weeks of the bottom. If you panic sold, you not only locked in your losses, but missed the massive rebounds. Between 2007 and 2009, the market fell 57%. Those who stayed invested and continued to dollar-cost average into index funds were buying shares at prices that would triple or quadruple by 2021. The crash didn't hurt them, it set them up. To summarize, market crashes are routine. Compounding is powerful, but fragile if interrupted by emotional decisions. The asymmetry of losses means that being out of the market at the wrong time is devastatingly expensive. Build your emergency fund, automate your dollar-cost averaging, diversify your assets, and stick to your written plan. The people who thrive during market crashes aren't necessarily smarter or luckier, they are simply prepared. And now, so are you. If you want to learn how to build a simple, diversified portfolio from scratch, watch my next video and subscribe. Just remember, I am not a financial advisor. This content is for educational purposes only, and your results depend on your own informed decisions.